Dr. Summers, secular stagnation or financial repression? The choice is yours.
I'm not sure either of those things. I suspect that interest rates are going to be higher over the next 5 to 10 years than is currently priced in. In part, that's because I think there's more risk that inflation, considerably more risk that inflation will average over 2% than there is that inflation will average below 2% in the United States, given where we're starting from, given increased risks on the supply side, given increasing pressures coming from the labor market. In part, that's because I'm not sure we're going to see quite as low real interest rates over the next decade as we have in the last decade. While some of the pressures for low real interest rates, the demography, relatively slow growth, low-priced capital goods, high levels of inequality are still going to be operative, my read would be that a higher level of government debt operates to push up normal real interest rates, and the combination of increased resilience investments. If you have to build two of everything to make sure you're resilient, then capital investment is going to be much greater. And energy transformation investments, those two things are going to operate towards higher investment relative to a pool of saving and to higher normal levels of real interest rates. So my guess is the Fed's next revision on neutral interest rates will be upwards rather than downwards. And if you have to be above neutral interest rates in order to bring inflation down or to hold inflation down, I'd be looking for somewhat higher real interest rates than we've become accustomed to over the last decade.
But it's also about educating groups of investors, the marketplace, economists, to a new higher neutral rate, something that we need to shift our mind to. What is that in your thinking? Where is the new neutral rate?
You know, journalists like you always like to get people like me to give specific numbers so you can write a little story.
You can give me the bandwidth.
Cuts out all the qualifications and have something to run with. And people like me tend to prefer to keep the conversation a little bit more qualitative. I guess what I would say is that I think we're likely to come out of this period with debt to GDP ratios 40 or 50 percentage points higher than they were before, and somewhat larger deficits. And then I would say that a rule of thumb would be that each point of debt to GDP raises real interest rates by 2 or 3 basis points. And that plus the resiliency investments plus the energy investments could lead one to think that wherever neutral real rates were before, they might be 100 or 150 basis points or even slightly more than that higher going forward. Now, it's also possible that the trends that were reducing neutral real rates will continue. So I don't have high conviction, but I think there's probably more room for surprises in the direction of high neutral real rates than for surprises in the direction of lower neutral real rates. And while I've got some concerns about the mechanics of Treasury markets, I don't think that, given the really quite low share of taxes in GDP in the United States, given that leverage in the household sector, I think properly measured, is not especially elevated at this point. Leverage in the corporate sector raises concerns in some limited sectors, particularly around some private equity deals. I don't think that the magnitude of debt problems is such that I would expect there to be substantial pressure towards financial repression. I also think in a modern world of more open and more sophisticated financial markets, even if governments were to desire financial repression, it's a more difficult thing to carry out than has been the case historically.